So pretty often I get asked how to build a well-diversified portfolio, and the reality is a little different than what people want me to say. They want me to say something like buy X% of this and Y% of that and Z% of the other. And that doesn't help you really understand the game. When you think about what diversification means, it doesn't really mean what people mostly through most of history have thought it meant, and still today what most people think it means. What people used to think, and what today still most people think, is it means kind of, if you will, spreading your chips around over the course of a lot of different things. That is not actually diversification. When I was a boy, Harry Markowitz defined diversification as we know it technically today. And what diversification means is, what you're supposed to do is identify things, could be any kind of things, that have similar long-term return expectations. But in the short term, when the one rises, the other tends to want to fall, and vice versa. And when you blend them together and have some of both, you get that long-term return with less volatility on the path to it. So if you think of saying this kind of stock doesn't move at the same time as that kind of stock, but in the long term they do about the same, you put them together, you get a smoother pathway to that long-term return. And so you're supposed to look through all kind of stuff and play that game, blending things that vary differently together in the short term. Now, here's the problem. Said simply, in the long term, correctly adjusted, long-term returns of major categories aren't very similar. Gold, for example, that a lot of people want to include in their portfolio and you just can't get them not to, has a very, very high volatility relative to most things that are liquid, and yet a markedly lower return than, let's say, stocks, much more like bonds. So it's very, very hard to say you'd pair stocks and gold together because of the difference in the long-term returns. Unless you say, which is a correct way to think about it, you don't expect stocks to have that higher long-term return ahead that they've had over the last 100 years. You expect now them to have similar returns and move differently. That's the game, because it's always at the end of the day about what will have higher long-term returns and finding things that have similar high long-term returns with different paths to get there. That's how you diversify a portfolio broadly and correctly, as opposed to just buying lots of different things. Thank you so much for listening to me. I hope you found this educational and useful. Hi, this is Ken Fisher. Subscribe to the Fisher Investment YouTube channel if you like what you've seen. Click the bell to be notified as soon as we publish new videos.